Hello everyone and welcome. My name is Tim, trader at the Calm Compound, a company of professional traders where we show you exactly why, where, when and how we invest. Let's get right to it as today is our stocks day. So in front of us we have the S&P 500 and it is notable that it was a decent day, but it wasn't a great day, despite the fact that we had a good CPI print yesterday. Now, what does this mean? Because the inflation print was only 5%, where people were expecting, or the experts were expecting, 5.2 to 5.3%. Generally, this leads to a resurgence in the markets. However, on the other hand, we have some credit market issues. Now, a lot of people think that the stock market, also known as the equities market, is one of the major indications of what is happening in the economy. However, the other side to the equity market is the credit market. Basically, the market full of loans, interest, and that sort of stuff. What we see there is actually a collateral crunch. What does that mean? Well, for a loan or for a debt or whatever, anything of that type of credit, you also need collateral, something to underpin it, to be like, to have at the moment that the person who takes a loan is unable to pay, you can say, hey, here is this asset that I have and I will sell it in order to pay you back. For instance, if you take out a mortgage on a house, then you have the house as collateral. You can sell it to the bank, or you can sell it and then pay back the bank if anything were to happen. If everything goes right, of course. There are exceptions. There is a similar thing in the credit market. And to kind of give you an idea of how big this market is, the total stock market, US stock market, is worth, off the top of my head, I might be off a couple trillion, is about 20 trillion worth. Now, the credit market in its totality is more around 100 trillion. So imagine if something blows up there, it's not great. You don't want that. So what we are seeing right now is that banks are having trouble getting collateral. These are usually treasury bills, etc. If there is a collateral crunch, then treasury bills, which are, well, obligations, just T-bills, they are some of the finest collateral because it is basically an IOU from the US government, which is one of the strongest, most powerful at the moment. When banks cannot get to this collateral and they start buying it up and gobbling it all up, the rates tend to fall back down, which is a whole different thing. We can go into that. But for now, it is for you important to know that these collaterals are being bought up at a very fast rate, meaning that banks just need something to secure them. And of course, the bigger the bank is, and the bigger the bigger the buying power is that they have, and the more that they can lend in order to buy more collateral, which is a whole weird dynamic. I get that. The more it signals that the market is smelling something fishy. Because why would these institutions that usually would love to give you a loan, would love to give you a mortgage because it is, well, consistent income for them, why would they suddenly step on the brakes, hold that, be like, you cannot get a loan right now, hold your horses, I need to get me some collateral? That is usually not a great sign. Now, next to that, we also have inflation still being fairly high, and that is mainly in the housing market. So hopefully, at some point, that will come down at least a little bit too, if it is just to cool down. And we have the unemployment, which altogether kind of make a big triangulation of how is the economy doing. The last jobs report was a little weak. It was not great, it was not bad, it was just lukewarm, and that is that. Not a problem, generally speaking, but the labor numbers, just like the CPI numbers, are a little befuddled. They're a little messed with to kind of get the right numbers out there that the Federal Reserve needs in order to push their agenda through for what they think is right. And let's give them the benefit of the doubt. They probably do what they think is right. I should hope. However, if we take the U-Star labor statistics, then this already shows a far higher unemployment, which would make sense because people are having a bit of a hard time with that. You can see that by just looking around. More unemployment, more homelessness, etc. So there's a little there. All of this serves to the point of under the surface of the economy there is some trouble brewing, and we are seeing that in the credit market. We have been telling our members, our premium members, for a long time, I think the past 6 months at least, that if something is to blow up in the time to come, it will probably, most probably, there's never certainties, only probabilities, but it will probably come from the credit market, and we are starting to see more and more cracks across the globe, not just in the US, but also in Japan and also in China, where the municipalities are having some serious liquidity troubles. Now, again, all of that could each could be a separate video of like 20 minutes with a whiteboard where we can explain everything. It's not the point, but to get back on track to stocks, the lukewarm reaction might just be because the market is catching up that there is something afoot. And now you do too. Hopefully before the herd, because the herd is still euphoric that the market is going up. The masses are still euphoric that the market is going up. And you don't want to be part of the masses because the masses are usually slaughtered by the market. The stock market, or any financial market for that matter, is made so that it looks easy, but that it fools 98% of the people into losing their money, unless you have a very clear strategy. And that is also what we at the Calm Compound do. We help you with that to, well, compound in a calm manner, so no stress, that you know what's going on, that you can learn from us, and then kind of start dipping your toes into it. So, if that sounds interesting, do follow the link in the description. Say hi in our little community if you want to. And otherwise, ring the bell or notifications or subscribe, one of those things, to make sure that you check in every now and then, because sometimes I talk about cool stuff. But now let's get actually into the markets. Now that we've had the boring fundamentals out of the way, let's get right into the technicals, into the charts. What do we see? Well, in front of us we have the S&P 500, and what I want to show you here is that we have this beautiful W pattern. It does somewhat seem like it's not a perfect W pattern because it came in from the upside. Usually you would like it to see something like this, and then you can say, alright, we'll probably move back up to this point. However, a triple tap is a triple tap, and we'll take it. For now, we could say we have 1, 2, and 3. There is a decent chance of us moving about, if we manage to break out properly, which we'll get to in a second. So here, we could move back to about, let's say, 446 to 450. So that's kind of this area right here. However, what we do see is that there is a bearish channel upwards back into this resistance. What would we need in order to break that? Well, we would need to basically, it's not perfect, I am well aware of that, don't worry, but we would need to break above, confirm properly and not fall back inside of it, and we would also need to confirm well above this resistance area right here. It is also taking a bit long, but usually speaking this would at some point reverse for a break back down. Now, the fact that we have 1, 2, 3 taps and now a 4th one in rapid succession does kind of give us a 60% chance that we will now actually break through and move at the very least towards this high at around 428 to 430. That's kind of what we're looking at, and like we said, possibly that 450 area right here. But in order to do that, we would either need to consolidate out of this range or out of this pattern or break out to the upside. I would prefer consolidation, meaning that we go sideways and that we kind of make sure that we have a nice base before we continue onwards, because if we just shoot up out of this pattern all the way up to 430, the steeper an incline is, the less likely it is that we will actually manage to continue on, because a steep incline takes a lot of energy for the market and thus will sooner be broken. If you want to have a sustainable sort of rise up, then you need the consolidation. And a prime example of that happening right now is XRD, which is one of the coins that we've been talking about a lot actually over the past weeks. This is a parabolic rise right here, and at some point you want it to kind of stagnate to the side, preferably just straight across before it can continue upwards. But for now, this is a perfect move, and I'm very grateful for it. But let us continue to stocks. That is what we were doing tonight. So, what do we see in the triple Qs? In the Nasdaq, kind of a similar idea. Yesterday we went back down to test this support area. It is a supporting, or the price action is supporting possible further upside. It's not perfect, but you do see that we're kind of breaking out of this area right here. Sorry. Out of this area right here with a decent chance of moving towards the 333 like we're seeing and like we've talked about. But as mentioned, it is just not as euphoric as you would expect, which is, in my opinion, probably a good thing, because the way things are looking now, and I want to not jinx it, but it does look like there is a deeper recession still to come. Especially if you take all the treasury markets, and like maybe I'll make a video on that at some point just in general. But for now, there does seem to be some stacking evidence that there will be a recession somewhere between, let's say, July and December of this year, that we will probably, or that we will properly see the start, so be prepared. And this might just be one of the first real signs in the equity markets, so in the stock markets, which we've just learned, that this is starting to kind of take hold a little bit. That is a big claim for just 1 day or 2 days of trading data, but that is kind of the undercurrent that I sense here. That aside, the Nasdaq could still rally all the way up to 333. Now, what are we doing with that? We are currently very slowly scaling into shorts. For instance, Eli Lilly, we have right here. We actually got our fill today, which is very nice. We have this overarching resistance area. We have a beautiful bearish divergence. So we have a move up there and then a move down here. Very nice resistance, and we are in a bearish channel. And if you look on the weekly, there you go. You see this parabolic rise again, and of course we still have a day and a bit, but you also see that the volume is tapering off. Now, if you're moving up, or if you have an extended move to one side, especially without breaks, and your volume starts to taper off, what does that tell you? If you think about it, your price keeps going in the same direction, but with less and less steam, with less and less fuel. There's less and less money backing it. So, in this case, you would say, hey, maybe the bulls are running out of steam. We've got a bit more until our, whatchamacallit, resistance. Lost the word there for a second. So we can scale in relaxedly and then make the most out of the way back down. That is kind of what we're looking at. Do we have a decent gap here somewhere to... Nah, not really. So we would probably be looking at 350, or maybe, there's a bit of a gap here, 354. Where would that bring us? I'm not going to try and do math out of my head. That would be 5%, maybe here, this area, around the 10%. That's kind of what we would be looking for right now. So that is one. Similar with, actually, crowd can be back in the what are we looking at category, because we canceled it. The market just wasn't really looking right at the moment when it came back up, so we'll get into it at a different point, but for now, not really feeling it. But for instance, Nvidia is stalling right here at the top, maybe a bit of a distribution top. We are waiting for that to come back down. There's a big gap to be filled. So we are slowly but surely moving into our shorts. There's a couple over here, for instance, like AEM and KBH, that we're just kind of preparing for the way down. Now, we also have a couple of longs running at the moment, just to kind of keep our bias out of it, and if the market allows for it, it's always nice to have a bit of a, to not be completely short or completely long, but to have a bit of nuance in it, to make sure that you're prepared for as many scenarios as possible, but only if your criteria are met. So make sure that you have those first, and if you still need a set of criteria, we're always happy to help you with that. But that is all I have for you today. I think that is enough of an info dump. Hopefully this was useful to you, and hopefully you have a bit of an idea of what's going on and how to look at undercurrents in the market. And otherwise, I will see you all in the next one. In the meantime, keep calm, keep cool, and keep compounding. Bye bye.